Ladies and gentlemen, good day and welcome to Yes Bank's Q3 FY’25 earnings conference call. On the management panel, we have with us today Mr. Prashant Kumar, Managing Director and Chief Executive Officer, Mr. Rajan Pental, Executive Director, Mr. Manish Jain, Executive Director, Mr. Niranjan Banodkar, Chief Financial Officer, Mr. Pankaj Sharma, Chief Strategy and Transformation Officer, and Mr. Sunil Parnami, Head of Investor Relations and Sustainability. Mr. Prashant Kumar will now give you an overview of the results, which will be followed by a Q&A session. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. Before we proceed further with this call, please note, while all efforts will be made that no unpublished price-sensitive information would get shared, in case of an inadvertent disclosure, the same would, in any case, would form part of the recording of the call. Further, some of the statements made in today's call could be forward-looking in nature. A note to this effect is provided in the Q3 FY’25 results presentation itself, shared on the bank's website. I now hand the conference over to Mr. Prashant Kumar. Thank you, and over to you, sir.
Thank you. Very good afternoon, everyone. I would like to start by welcoming and thank you all for joining us for Q3 FY’25 earnings call. On this call, I am joined by the senior team members of the bank. On behalf of the entire leadership team at Yes Bank, I would like to wish everyone a very happy and prosperous New Year 2025. Moving straight onto our Q3 results, as you would recollect, few quarters back, we had outlined a detailed profitability improvement roadmap, which at a headline level was essentially centered around improving bank's operating profitability via improving our margins, fees, and reducing our cost. We had also guided for our sense of recoveries and redemptions from our security receipt portfolio. I am humbled to report that despite multiple headwinds around liquidity and deposits, system-wide credit strain, and latest economic data indicating some mixed trends, we have remained right on track and delivered 5 consecutive quarters of sequential expansion in net profits. What is more encouraging that the bank has delivered a 25% YOY and 10.6% sequential growth in our third quarter pre-provisioning operating profits at 1,079 crores. This is second successive quarter of operating profit expansion. Further, PPOP as a ratio to average assets improved by 10 basis points both sequentially and on YOY basis, and inched up to 1% from 90 basis points. Having said that, as we look to replicate the same over the coming quarters, we would remain extra vigilant of the external macro, be more prudent and calibrated, yet nimble and agile in our approach and actions. Talking of individual components, in Q3, our net interest margin came in at 2.4%, flat both sequentially as well as same quarter last year. From margins standpoint, it was an important quarter of inflection as it marked the beginning of meaningful reduction in our outstanding RIDF deposit balances, which reduced by over 8,000 crores, largely towards last week of December 24. These RIDF deposits now stand at around 8% of our total assets, as against 10.5 to 11% over the last few quarters. As a result, bank prudently reduced its borrowing by 11% quarter-on-quarter. As outlined earlier, going forward, while we may continue to see some RIDF-related calls, majorly for periods prior to FY'24, but on net absolute basis, bank looks to be well on course to reduce the same below 5% over the next 2 to 3 years. Moving on to cost of funds and cost of deposits, both of which were largely flattish over Q2. Our deposit engine has been firing well with sustained pickup in our CASA balances and CASA ratio, which we believe over time would start to also meaningfully contribute in our operating margin expansion and profitability. As on at the end of Q3, total deposits at 2.77 lakh crores, which is up 14.6% YOY. CASA and retail TDs, that is up to 3 crores, is now at 62.6% of our total deposits. In Q3, our average daily saving account balances have grown 32% YOY, and current account balances have grown by 22.1% YOY. As you would see on page 4 of our investor presentation, over last 4 quarters, we have improved our CASA ratio by nearly 350 basis points, unlike the industry trend, which has seen a drop in their CASA ratio over the same period. This reflects the trust in Yes Bank brand, a strong acquisition engine, a very well-run deposit franchise, which has been consistently delivering through right customer selection, a strong customer value proposition, a motivated team, right incentives and performance scorecards, and an integrated best-in-class tech stack. Not only that, and as we have been articulating in the past, we have also seen really leveraging our branches as a core fulcrum of our business and generating assets and fee-based businesses out of those branches as well. Talking of our customer value proposition and technology, we recently launched our flagship all-in-one super app for businesses called Iris Biz, bundling over 100 plus features over mobile and web across payments, collections, tax payments, and other business requirements. The bank continues to see very good traction in its next generation UPI payment app, namely YesPay Next and YesPay Business, strategically targeting non-Yes Bank retail as well as business customers. Details of all these initiatives have been given on page 18, 19, and 20 of our investor presentation. We believe this, coupled with our leadership in digital payment ecosystem and fast market share gains in NET and ECH business, gives us a distinctive edge which would further fuel our CASA as well as cross-sell engine. Speaking of our fee income, the same came in at 1,512 crores, up 26.6% YOY and 7.5% sequentially. It is pertinent to highlight that our fee income as a percentage of total assets is currently at 1.5% and has seen a steady ramp up of 20 basis points over the last 8 quarters. It reflects our consistent synchronized execution, and going forward, we expect this momentum to continue and be aided by our distribution ramp up and sustained improvement in our sourcing, cross-sell, partnerships, servicing, customer delight, and technology. Talking now of our OpEx cost, Q3 was second successive quarter wherein further the bank delivered an improvement in the cost-to-income ratio. Total operating expenses at 2,657 crores, up by 13.2% YOY and only 0.9% sequentially. As guided earlier, with asset mix largely remaining stable between wholesale and retail, coupled with our ongoing transformation exercise, including right-sizing initiatives and greater leverage of technology, productivity, and process improvement, we expect our cost-to-income ratio to continue to further improve from here on. So to summarize, we are well on track with sustained pickup in our deposits and CASA, 100% compliance in PSL and its subcategories, RIDF resolution already underway, our cross-sell, fees, digital payments, and transaction banking flows thriving well, and cost-to-income ratio is starting to improve. Now moving over to advances and asset quality. At a headline level, there is no change in our overall strategy, and we would like our current advances mix between retail and wholesale, which is currently around 60-40, to largely remain the same over the medium term. Though having said that, this ratio may see some transitory movements between quarters owing to change of gears, risk, and profitability calibrations across segments. A flexibility or advantage that comes with being a trusted universal banking franchise with full range of products catering to various customer segments. In addition, within the segments as well as between the products in a particular segment, we would continue with our strategy of profitable growth, though the overall pace of growth may moderate depending upon external macro and our internal risk-adjusted returns thresholds. For quarter ended December 24, our advances have grown by 4.1% sequentially and 12.6% YOY, with strong growth in our mainstay segments of SME and mid-corporate, which continue to deliver growth in excess of 25% on a YOY basis. On the other hand, our retail advances were flattish quarter on quarter and were down around 3% YOY due to ongoing recalibration aimed at profitability improvement. You can see the differential growth rates across the retail products on page 44 of our investor presentation. In the corporate segment, we have maintained the growth momentum of last few quarters. On asset quality, I won't go into the headlines details, as all these vectors have performed in line with trend of last several quarters, and you can find them in our disclosures. Our net NPA along with net carrying value of security receipt as percentage of advances now stand at 0.6%. We had guided for our SR security receipts to have negligible or nil value by end of FY'25, and we are well on track towards that, as the net carrying value stands at 233 crores as of December 2024. Another key highlight in overall numbers is the strong recoveries and resolution at 1,843 crores, which takes the cumulative recoveries and resolution for 9 months of the current financial year to over 4,400 crores. We are on track to achieve the guidance of 5,000 crores for FY'25, and we would like to highlight that the SR portfolio would continue to contribute towards our recoveries and resolution, even after becoming nil in terms of net carrying value on our balance sheet. Now I would like to draw your attention to slide 6 of our investor presentation. Here we have laid out several matrices with respect to our retail asset quality. As you can see, the retail slippages, which includes the rural portfolio, has been flat on a quarter-on-quarter basis despite the adverse operating environment, especially on unsecured products, including the microfinance. On a one-year lag basis, the slippages have actually marginally improved as percentage of advances. Within this, the secured portfolio has seen sharper improvement in terms of slippages, and even within the unsecured products, except for microfinance, other products have seen flattish trend in quarter 3. Another encouraging trend is that early delinquencies in the form of 31 to 90 days, overdue loans are now stabilizing across both secured and unsecured products. I would like to highlight that this has been an outcome of several interventions and actions with respect to our underwriting, scorecard, collections taken over the past 9 to 12 months. As I conclude, let me reiterate that all the key business vectors are progressing in desirable direction, including the two important trends that we have seen this quarter in form of the reduction in RIDF balances and flattening out of retail slippages. I would like to thank you all once again for your continued interest in our franchise and progress. Lastly, before we take your questions, let me convey my advance wishes for our 76th Republic Day. With this, we can now take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. We have the first question from the line of Jai Mundra from ICICI Securities. Please go ahead.
And congratulations on steady buzz. And thanks for additional disclosures this time around on unsecured and a lot of other areas. Sir, I have few questions. First, if I were to calculate the slippages, right, the way you have defined PL and credit card slippages, it looks like PL slippages in absolute number in percentage are more or less stabilizing, whereas credit card slippages are rising, whereas the loan growth is actually the opposite, right? So PL growth has been lower, declining YOY 10-12%, whereas credit card growth has been 25% YTD and maybe 30-40% YOY. So I'm just not able to understand that of these two unsecured products, one is having higher slippages but higher growth, and another is slippages are stabilizing but lower growth. So if you can sort of elaborate that.
Yeah, Rajan here. Your observation is correct. Now, in credit cards, the way the book grows is always, with a lag, because whatever you acquire subsequently, builds up as the utilization, and hence the book growth, what you see over there. While we are also, we have also calibrated the growth in credit cards vis-a-vis our potential. Now, while in cards you are seeing a higher slippage, but if you look at when we are looking at the 30 plus 6 MOB, 3 MOB, we are seeing a flattening again, like PL, what you see as a trend in the slippages. So both the portfolios, they actually need to be looked at a little differently. PL, one of the other reasons why you see a slowing up of the business was also in terms of us trying to recalibrate our scorecards in view of how the market is behaving and how the macro factors are impacting. So you're right, PL has shown a flattish trend in slippages, and also in the business growth it has come lower. But from here onwards, PL, we will be in a position to ramp up, but to the correct segments, and we will again continue to have a calibrated strategy for the credit cards as well. But I can tell you, both of them are showing at a 6 MOB little flattish, kind of trend, and we expect that to continue.
So, Niranjan here, if I can also add a couple of more points. One, the credit card book, if you look at it from a sequential standpoint, is also not growing at the same pace as it was growing in the past. I think that's number one. Number two, and that's the nature of the product, the ability for us to, let's say, intervene and de-risk the credit card works very differently from, let's say, a PL. In PL, you can slow down the disbursements. In credit cards, the mix of revolver can change, while you can still have a book that could kind of play out, right? So I think our approach to unsecured, whether credit cards or PL, I think we've been working on it and look at both these sectors with the same lens. It's just that there are nuances to individual products, and we do believe when we look at the 30 plus and lead indicators of risk, that some of the plateauing is playing out. In fact, if we look at the new sourcing on credit card, while these are very early indicators, if we actually look at new sourcing of credit cards, the vintage curves are actually showing us far better performance on credit cards. But anyways, I think we'll have to see how some of that data will also play out over a period of time. But I just wanted to make sure that there is no discerning in the way we will look ultimately from a risk standpoint between a credit card and PL. It's just that sometimes it's the nature of the underlying product.
Right. Okay, so just to understand this, if you say within credit card, would you say that maybe last 12 months origination, their delinquency is lower than the blended one, or and hence, can you make that comment that, let's say, the new origination after your tightening of rules, are they behaving better than the blended number, or they may still be higher than the blended, but better than a historical curve?
So for both PL and credit cards, the sourcing quality of the recently acquired portfolio is definitely trending well, because everybody in the market, there is a fair bit of tightening on the norms.
So actually, it is behaving very well, and hence the slippages are stabilizing. But what I wanted to check is this better than the blended one, or this is better than a usual vintage curve? That was actually, if you can specify.
Yeah, portfolio plays on an average, after 6 months to 12 months. That is how it behaves. But the early indicators are definitely better than the blended. But the blended also has a lot of shades, the part of portfolio which was doing well and the part of portfolio which had, a concerning trend. So vis-a-vis that concerning trend, we are seeing that the pullbacks are better.
In any case, Jay, I think we should also keep in mind the fact that if you look at our unsecured as a proportion to retail assets, and actually if you look at that as a proportion to total advances, we are talking about this portfolio sub 25% for our retail assets, right? So that kind of gives you a good sense that we are not running like at a bank-wide level. My bad. So it's not that we are looking at a very material risk at a full bank level to kind of come and hit us as well.
Right. Sure. Secondly, on savings growth, right? So we have been doing exceptionally well in terms of growth, whereas other peers are struggling, and outperformance has been very remarkable. If you can also comment, so we have the graded SAR, right? We have 3, 4, 5, and 7% SAR offering. Is this the savings growth also in a way inching up your blended SAR cost, or of course, apart from execution, is pricing is also paying a little bit of a difference. So if you can comment, what is your blended SAR cost in Q3 and maybe versus last quarter and a year before?
So on that, Jay, our blended SAR continues to be stable actually over the last almost 3 to 4 quarters. And this is despite some of the rate actions that we took more than 12 months back across different buckets, where we actually took the headline rate higher for balances more than 10 lakhs. But despite that, over the last 1 year, in fact, our SAR cost is largely anchored. I think it hovers around, let's say, 5.8, 5.9%.
Sure. And lastly, on security receipts, so now the unprovided book has come down to 233 crores. Assuming you maintain similar 1,000 crore kind of a recovery per quarter run rate, does this mean that next quarter onwards, you will have, assuming a 1,000 crore recovery, you will have a negative kind of a provisioning also, negative credit cost if not in 4Q, then probably from first quarter onwards.
So there, I think if you see the outstanding security receipt has come down to somewhere around 2,400 crores. Okay. So expecting like we would continue to have a recoveries of 1,000 crores per quarter, definitely is not going to happen, because this is a case which takes a longer time for resolution. But we would be definitely expecting a recovery of something around 1,200 crores every year, and overall 3,000 crores plus from this portfolio.
Okay. So 1,200 crores per year, right?
Yes.
And what was the 3,000 crores? Is it total recovery?
From the pool, over a period of time.
Okay. So, and sir, just on credit cost, how do you look at, now you have come to a very significant milestone where, SR book may become almost zero, maybe by next quarter. How should one look at, and you are saying that, retail slippages are stabilizing. How should one look at credit cost? Could it be like insignificant 20-30 basis point, or it will still be, let's say, 50 basis point?
So Jay, on credit cost, we said last year that we will be comfortably below 50 basis points. That is what we had said earlier. I think just from the way the ARC recoveries work, they kind of give us some choppiness. Sometimes in one quarter it might be higher, sometimes lower. But we do believe on an average, our credit cost should continue to be in the range of about 30 basis points. But again, this is not a guidance. These are just initial estimates. We will frame our guidance and come back at the end of this year.
Sure. Thank you so much, and all the very best.
Yeah, I just one quick clarification. I don't know if you got that right, but the unsecured book is actually less than 25% of the retail.
Right.
To actually look at that from a bank-wide perspective, is less than 10%.
Correct. No. So that was very clear.
Okay,
Thank you.
Thank you. The next question is from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Hello.
Sir, you are audible. You may proceed.
Yeah, sure. So yeah, the good set of numbers, and thanks for taking the question. So firstly, the disbursement run rate seems to be marginally lower. So anything that we should know about on a year-on-year basis?
So that's largely a reflection where our retail disbursements have come down.
Okay.
So that is, we were speaking about the recalibration of our retail asset portfolio, which is also in terms of staying away from the very low yielding assets and also the tightening the underwriting for some of the unsecured loans. That has resulted into a lower disbursement YOY, but now we are inching back towards the normal, which will take some time. But next year we are quite confident that we would come back to the normal disbursement and which would result into a growth in the retail assets.
Yeah, the details, Rakesh, you will find on slide 44. We have the disbursements in absolute rupee crore given on the presentation.
Correct. And this cost income ratio, which is coming down for corporate book, is it due to like loan pricing issue that is prevalent in the system, or it is due to the asset quality, like because interest reversal number? So what is the reason for that cost income in the corporate segment having gone up?
I'm assuming, Rakesh, you're referring to the segmental results?
Yeah.
Okay. So, see there, ultimately, I mean, it's the nature of the corporate business where you're able to build a scale, and that does not come at any incremental cost, effectively. So you will kind of see that from a cost to income standpoint. They operate at very, low cost to income.
But fundamentally, like what you were saying, the reason is more in terms of very fine pricing which is happening in the market on the corporate side, but not because of any kind of slippage.
Understood that. Yeah, because in this environment, like it is more of a retail phenomenon.
Yes.
And on the SR side, sir, like, so net of, provisions that we are doing, how should we see the run rate might be in FY'26?
So Rakesh, we've not given the guidance on credit cost. But let's say I think I did allude to that question in the previous question as well, which is, this quarter we are at about 20 basis points of credit cost. And if you look at the split of that 20 basis points, we have about 60 basis points, that is the write back that we've got from the ARC. And we have about 70 basis points of credit cost on the NPA. We do believe that a function of the normalization of this credit cost, and we've also kind of assuming that we will not have 600 crores of write back every quarter. We do believe that we might have a 10-15 basis points of uptick in the credit cost, but I think it should still be well below 50 basis points, and our sense is about 30 basis points of range is where we should anchor our credit cost to. And this is to total assets, just to clarify.
Okay. Sure. Okay. Sure. Thanks a lot.
Thank you. The next question is from the line of Dev from Horsepower Securities. Please go ahead.
Yes, good afternoon, gentlemen. Can you listen my voice?
Yes.
Yes, congratulations on having a excellent bottom line figure and expected top line NII figures. Congratulations to all of you.
Thank you.
So, I have two questions regarding your result. So, first of all, I want to know if you go by your segment result disclosure sheet, retail segment is still in loss. I mean, how many more quarters would you take to recover the retail segment into black or break even?
Yeah, why don't you complete your set of questions? We will respond to that.
Yes, second one is regarding the stake sale. Till the stake sale goes on or goes completed, why don't you go for QIP?
Okay, I'll take the first question. This is Niranjan, and I'll request Mr. Kumar to speak about stake sale. So on the retail loss, if you look at the way the retail segmentation is, and it's also a reflection of the way the method for the segmentation works out. So our entire branch distribution, infra, people cost is all loaded into the retail segment. And then, of course, what we are also encountering over the last 4 or 5 quarters is the fact that we've been making higher provisioning as a function of the slippages that we've had in the retail business, right? And the point I think we were making earlier is, so we've slowed the book down with the clear focus that we will want to focus on profitable products. Now, it takes time for this, the new portfolio to start taking shape and start becoming dominant part of the entire book. And that journey, once it starts playing out, you will start seeing the effect of those in your profitability for the retail segment, right? But we are kind of working quite meticulously on solving profitability of retail assets, and that will happen with the change in product mix as well as normalization of the credit cost. Second, what we are also doing is on our entire branch network, we are making sure that we are very frugal and efficient by not overloading it with cost to scale up businesses. And we've been able to demonstrate that also over the last 12 months. So if you look at our cost of deposits and our operating cost growth is actually quite contained as compared to what you will see in terms of the deposit growth that we are delivering, right? Now, it is a matter of, I would say, evolution where the credit cost will have to normalize, which we are confident about, but it will take some quarters. Once that happens, you will start seeing contribution from the retail business go up. In fact, as we look at our ROA journey, of 1% over the next 3 years, the swing or the delta that will come in will actually be going to come materially from the retail business, and we are all working towards that. But we are very conscious about the observation that you made, and we are working trying to execute each of those aspects. That's number one. I think the second point you had was on stake sale. While before I hand it over to Mr. Kumar to take that question, I think the one point I wanted to call out is if you look at over the last 3 to 4 quarters, we've hardly consumed capital. And this is despite, the advances book growing in excess of 10%, our trade book growing. And that's because, of course, one is we continue to see improving, rating profile or quality of assets on our advances book. It's also the discipline with which we are now managing the balance sheet, right? It's a function of the two, and also improving profitability. So we reported CET1 at 13.3%. If you go back to our pro forma CET1 post the warrant exercise, which happened in June, we were at 13.4. So the last 9 months, effectively, we just consumed 10 basis points. So just from a capital standpoint, I think 13.3 is reasonable. Of course, at some stage we will have to look at capital, but we do believe we have enough capital in play to grow from here on as well. But I'm going to now request Mr. Kumar to speak about the stake sale.
No, I think Niranjan has already responded in terms of, but we have taken your suggestion. But currently we don't feel the need for raising any equity because our core equity at 13.3 is adequate to take care of our growth requirement.
Okay. And last question, if you don't mind. Yeah, from here on, can we expect your provisioning to come down quarter on quarter for at least 3 to 4 quarters?
You are saying provisioning coming down?
Yes, the provision for NPA. The credit cost you...
We are currently around, say, 71% on the provisioning coverage, and we would like to see that our provision coverage would remain at the same level.
Sir, at what percentage would you feel comfortable? So,
around 70%. Around 70%.
Around 70%. Okay.
Yes.
So, okay.
Thank you.
Thank you.
Ladies and gentlemen, we request you to please restrict your questions to 2 questions per participant. You may rejoin the queue for follow-up questions. The next question is from the line of Srinivas, an individual investor. Please go ahead.
Yeah, good afternoon. As I can see, there is improvement in the CASA ratio, and there is also improvement in the RIDF deposits as a percentage of the total assets. But these two things together, they should translate into higher NIMs, net interest margins, and consequentially, better bottom line and higher ROA. But NIMs are flat, like it's at 2.4% for the last 2 quarters or so. So why this is not happening? The improvements on both these fronts should lead into higher NIMs, no? Like, why that is not happening?
So, Mr. Srinivasan, I think you made both the points right. On the RIDF, if you see that reduction has happened in the last week of the December quarter. Okay? So its impact will start happening in the current quarter. That is one part. Second thing, that NIM expansion is also a function of your cost of deposit and yields on the advances. If you have observed that we have recalibrated our strategy on the retail asset side, which gives a better yield and better NIM. And I think we are expecting that going forward, especially with the start of the new financial year, we would see the growth on the retail asset, which is going to help us in having the better yields and the NIM expansion.
Okay, thank you.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. The next question comes from the line of M.B. Mahesh from Kotak Securities. Please go ahead.
Hey, hi. Just one question on this new ARC guidelines that came in, or a clarification that has come in with respect to resolution that the ARC can do with their borrowers. Does it have any bearing on the expected recovery rates from your side?
I think we are not aware in terms of whether the ARCs are facing any issues in terms of this kind of resolution even as of now, and whether the change in the guidelines would help them in terms of taking the faster decisions. So since we don't have any, I would be saying any kind of, have this kind of business within the bank, so we are not aware what kind of impact it would be having.
But Prashant, just extend this point. Given that we are right now seeing a fairly good recovery from that book, you must be having some conversation around this guideline, right? Because you are also kind of looking at those numbers to see how much of recovery you will get in the next few quarters.
No, I think the issue is more in terms of if the guidelines become more stringent, then there is a cause of concern. If there is a relaxation in the guidelines, then I think that concern is not there, and we would be definitely seeing some improvement in that. But we really don't know whether there will be a correlation, because we are not aware that the ARCs are facing any issues in terms of not able to take the decisions because of this.
So far your assumption is that nothing has changed from your side?
Yeah.
Okay. And sorry, just to finish this point, what is the current outstanding gross amount of security receipts and the recovery rates expected?
So currently the outstanding SR with JCF is 2,400, around that. And I think if we go with the past track record, we would be seeing a recovery of almost 3,000 crores from this pool of the security receipt, and the possibility of also some additional recoveries from the security receipts which have been redeemed in full also cannot be ruled out.
Okay. Perfect. Thank you.
Thank you. The next question comes from the line of Janmajaya Mohanty, an individual investor. Please go ahead.
Hello. First of all, congratulations team on very good results.
So sorry to interrupt, but you do sound a little muffled on your line.
Hello. Can you hear me now?
It's a little better, but low in volume, sir.
Okay. So congratulations team on very good results. My question was regarding the 81.
Ladies and gentlemen, the current participant seems to have dropped from the queue. We will proceed to the next questioner, which will be Manish Soni, an individual investor. Please go ahead.
Hello. Good afternoon, sir जी.
Yeah, please go ahead.
सर जी मैं 2019 से मैं येस बैंक के इन्वेस्टर हूँ. मैं रिटेल इन्वेस्टर हूँ, छोटा इन्वेस्टर, बड़ा नहीं. बहुत सारे सर प्रॉब्लम्स आए हैं, मैं देखा हूँ, सब देख रहा हूँ सर. लेगेसी इश्यूज में आपने प्रोविजंस किए, एसआर के प्रोविजंस किए, नए रिटेल लोन्स के आए प्रोविजंस किए, टीएसएल का प्रॉब्लम था, आरआईडीएफ में डाले. सर मैं सब देख रहा हूँ, मैं कुछ बोला नहीं इतने से, मैं कुछ नहीं सर, मैं देख रहा हूँ सब. अभी मुझे क्या मजबूरी है बोलना पड़ेगा ये ESOPs के बारे में सर. सर हर महीना ESOPs इश्यू हो रहा है. जनवरी में सर 24 में 17 लाख, फरवरी में 27 लाख, हर महीना चालू है सर. 15 तारीख 16 तारीख चालू है. सितंबर में 28 लाख, नवंबर में 14 लाख. सर होल ईयर 3 करोड़ ESOP सर. इतना सर कोई एम्प्लॉयज को एक महीने में, एक साल में एक महीने में बोनस मिलता है सर. ये तो हर महीना बोनस मिल रहा है. कोई परफॉर्मेंस बेस है कि देते जा रहे बस. तो ये प्रिंटिंग नोट प्रिंटिंग की मशीन है आपके पास, छापते जाओ. ये रिटेलर, ये इन्वेस्टर को ही प्रॉब्लम है ना. इक्विटी डाइल्यूट हो रही है, नहीं हो रही है. दूसरा तो कोई होता है ना, चलो आपको चलो रिवॉर्ड करना है एम्प्लॉयज को, तो उनको बोनस दे दो, ठीक है, उनको एचआर दे दो, थोड़ा प्रॉफिट में से कम कर डालो. मगर इक्विटी इश्यू करते जा रहे हैं ऐसे. पहले इक्विटी बेस इतना बड़ा है सर, 4 लाख अपने पास. दूसरा इश्यू सर 4 लाख बैलेंस शीट है अपनी. अपन 1001 क्वार्टर में नहीं कर सकते प्रॉफिट सर. समथिंग इज रॉन्ग ना, क्लियर नहीं सर मैनेजमेंट में. नहीं सर, बैंक ऑफ महाराष्ट्र सर, मैं एग्जांपल के लिए आपको बोलूं, बैंक ऑफ महाराष्ट्र पीसीए से निकला 3 लाख की बैलेंस शीट, 1400 करोड़ 1400 करोड़ सर Q3 में प्रॉफिट किया. इंडियन ओवरसीज बैंक पीसीए में थी, निकली 3.5 लाख करोड़ उनका बैलेंस शीट है, 875 करोड़ प्रॉफिट. ये आईडीबीआई बैंक सर ले लो सर, 3.6 लाख करोड़, तो 1900 करोड़ प्रॉफिट सर. और अपना येस बैंक देखो सर, 500-600 हो रहे हैं खाली बस. और आप कॉन्ग्रेचुलेट कर रहे हैं एक दूसरे को कि भाई अरे हमने वाह काम किया. सर समथिंग इज तो रॉन्ग ना. कोई तो रिस्पॉन्सिबिलिटी लेना चाहिए ना सर. मैं तो छोटा आदमी सर, मैं 10वीं पास, मैं इतना कोई हाई फाई नहीं पढ़ा नहीं. आप लोग तो सब बड़ी बड़ी डिग्री लेकर सब बैठे सर. नहीं, इतना एक्सपीरियंस सालों का. ठीक है सर, शुरू में हुआ चलो वो पूरा 1 सेकेंड, जस्ट 1 सेकेंड, लेट मी कंप्लीट इट सर. 2020 में सब प्रॉब्लम हुआ, मैं माना. 1 साल 2 साल 3 साल मानो सर, 5 साल हो गया अभी तक सर. ये कभी चेंज होने वाला है? ये सब देते ही जा रहे हो और कुछ 1000 करोड़ तो प्रॉफिट कुछ दिख ही नहीं रहा है. कभी होगा सर ये सब? बस सर इतना ही मेरा सवाल था.
ठीक है. देखिए, एक तो आपकी जो ऑब्जर्वेशन है ना कि हर महीने ESOP दिए जा रहे हैं, वो ठीक नहीं है. जैसे आपने बिल्कुल ठीक कहा था, ESOP साल में सिर्फ एक ही बार दिया जाता है. होता क्या है कि जिस वक्त ESOP देते हैं तो एम्प्लॉयज जो है वो उसे एक्सरसाइज नहीं करते, सिर्फ वो ग्रांट होती है. उसको एक्सरसाइज करने के लिए उनके पास ऑप्शन होती है कि जब भी वो चाहे उसे एक्सरसाइज करते हैं, पर बैंक की तरफ से ESOP साल में एक ही बार ग्रांट होती है। ये जो आपको डिस्क्लोजर आते हैं, जब भी कोई एम्प्लॉय उस ESOP को एक्सरसाइज करता है उसको डिस्क्लोज किया जाता है। तो ऐसा नहीं है कि हम हर महीने ESOP देते हैं। ये तो पहली बात है। दूसरी बात, आपका जो कंसर्न है कि क्यों हमारा जो प्रॉफिट है वो 1000 करोड़, जैसे आपने दूसरे बैंकों का नाम लिया, मैं नहीं लूंगा दूसरे बैंकों का नाम, पर इसमें जो देखना है, आपने बताया हमारा बैलेंस शीट साइज। देखिए, अगर आप जर्नी देखें किसी भी बैंकों की, जिन बैंकों के नाम आपने लिए, आप मुझे बताइए कि कोई भी बैंक कभी मॉरेटोरियम में गया था? कोई ऐसा बैंक था जिसमें डिपॉजिट 2.5 लाख करोड़ से गिर के 99,000 करोड़ आ गया? तो मुझे लग रहा है थोड़ा सा पेशेंस रखिए। ये देखिए कि हर क्वार्टर ओवर क्वार्टर जो हमारा परफॉर्मेंस है उसके अंदर इंप्रूवमेंट होता जा रहा है। किसी भी फाइनेंशियल एंटिटी में कभी भी कोई ऐसा काम नहीं करना चाहिए जो कि बहुत हाई रिस्क ले। तो अगर आप देखें पूरी इंडस्ट्री में, चाहे वो डिपॉजिट की बात हो, चाहे एनपीएस की बात हो, क्वार्टर आफ्टर क्वार्टर वी आर मूविंग ऑन ए बेटर परफॉर्मेंस। मुझे लगता है कि जिस तरह आपने अभी तक सपोर्ट किया है, इसी तरह आगे भी आपकी सपोर्ट रहेगी। और थोड़ा सा आप इस चीज को समझेंगे कि हर दूसरे बैंकों का सबका जर्नी अलग अलग होती है। इस बैंक की जर्नी तब शुरू हुई थी जब इट वाज अबाउट टू क्लोज डाउन। उससे यहां तक पहुंचने में जो एफर्ट्स होते हैं वो किए गए। पर ये जरूर मैं आपको फिर से रिकन्फर्म करना चाह रहा हूं कि ये ESOP हर महीने नहीं दिए जाते, इस साल में एक बार देते हैं। आपको तब स्टॉक एक्सचेंज पे आता है जब एम्प्लॉयज उसको एक्सरसाइज करते हैं।
ठीक है सर, मगर 3 करोड़ ESOP सर लास्ट ईयर इश्यू किया सर, 3 करोड़ ऑलरेडी। दूसरा ऑल्टरनेटिव है ना?
नहीं, वो देखिए, आपके जो इस तरह के कंसर्न है, सजेशन है, वो बिल्कुल हम लोगों ने इसको भी है।
सर इक्विटी डायल्यूट होती है ना हमारी, तो मेन तो
नहीं,
रिवॉर्ड देना है तो आप दे दो ना, उनको बोनस दे दो, उनको HR में किधर ज्यादा करके दे दो, प्रॉफिट में थोड़ा कम कर दो 10 करोड़। पर ये ESOP इश्यू करना, इतना 3-3 करोड़ ESOP इश्यू करना।
अगर आप टोटल इक्विटी की परसेंटेज देखें जितने ESOP होते हैं तो बहुत ही मिनिमम है ना? तो डाइल्यूशन की जो आप पहले मेरी बात सुनिए, आप मेरी बात सुनिए, आपने अपनी बात कह दी।
ओके।
तो जो डाइल्यूशन है वो बहुत मिनिमम है। अगर आप इस डाइल्यूशन को कंपेयर करें किसी भी बैंक के साथ तो बहुत कम होता है। दूसरा जो आपके सजेशन है, वो अपने सजेशन आपके नोट कर लिए हैं, पर जिस वक्त ये डिसीजन होता है जिसके अंदर बोर्ड लेवल पर शेयर होल्डर्स से इसमें पूरा एक कंपेयर किया जाता है कि क्या देने से बैंक की बैलेंस शीट पे कम से कम इम्पैक्ट होगा। पर आपका जो सजेशन है उसको हमने बिल्कुल ध्यान में रखा है, और जब भी नेक्स्ट टाइम हम कोई ऐसा डिसीजन लेंगे दिस वुड बी टेकन केयर।
Thank you. The next question is from the line of Sigir Ramasubareddy, an individual investor. Please go ahead.
Yeah, am I audible? Can you please confirm?
Yes.
Yeah, please.
Yes.
Yeah, good evening, sir. Hearty congratulations to Prashant Kumar sir and Rajan Pendal sir and other board of directors. Again, these numbers were fabulous, and as per my expectation, it was beyond. Okay, so very all the best, sir, and congratulations. And some investors were talking about ESOP. End of the day, ESOP has to be distributed to the employees because they are working for our franchise, to improve further, and we must respect our board of directors because, without these members, without their degree, this bank would have been not in this position, okay? Because we should understand, like, when Prashant sir and Rajan Pendal, they were taking this company, it was posted around 16,000 crore loss, GNPA was 17%, NPA was 7%, and to raise the, capital and
Thank you so much for understanding. May I request you to please ask your question?
Sure, sir. Yeah. So, my question is, like, if you see quarter on quarter, right, the deposits are flat, okay, so 0%. So maybe like coming quarters, like end of this year and next year, this will improve or not, or it will be saturated? Because as you mentioned, we were coming from 99,000 crores, and now it is 2,60,000-70,000 approximately. So is it saturated for our bank, and we expect any growth? That is one thing. And if you see certain NIMs, our NIMs, okay, it's like 2.4. There is no improvement, though we were showing the profits from other incomes and all. So can you guide us on that aspect? Okay. So there was one question related to AT1. In between my call was disconnected because all this SBI, other private institutions, and even retail investors, FPO was successful because of write-off of AT1 bonds. Now again, I'm not asking anything how the bank is prepared, because we don't want any comments from the management, because it is under the Supreme Court right now. So how will the bank is prepared, okay, for in that situation? So if you could answer this, because 63 lakh retail investors are there, and you all know that how our S Bank stock is performing, even though other companies are doing well, public sector, okay, public or private sectors in India, okay. Our company is like, since from last year, if you see, though I understand that market cycles and all, so I would request our management to come and address what is happening in the bank and how we are preparing, okay. So it's not only me, okay. I do have patience. I'm going to wait 3 years, 5 years, and I wish my Prashant Kumar sir, Rajan Pental sir to be continued on the board, okay, for next 5 years, 10 years, though next year our Prashant Kumar sir tenure is going to over, but I request Prashant Kumar tenure and other board members, our leader should be there in the board.
No, so I answer all your questions. The first question was in terms of deposit growth. I think you have seen like flattish growth for this quarter 3. But I think you would like to continue to see the deposit growth, because how we are targeting that our loan growth, our deposit growth has to be higher than the loan growth. So whenever we see loan growth is improving, we would increase our deposit growth, but you would see continuous growth in both deposits and advances. Your second point was related to expansion of NIMs. I think I would like to bring to your notice one particular data point. If you see last 12 months, we have been able to protect our NIMs despite so many headwinds in the industry. Whereas some of the other competition, there is a pressure on the NIMs and there is a slight decline in their NIMs. So I think in these tough times, we have been able to protect our NIMs. We have taken multiple steps, and going forward, you would see the improvement on the NIM side also. Your third point in terms of AT1, as you are well aware, this case is pending before the Honorable Supreme Court, and now we are expecting, or the listing has been done in February. In this particular case, bank is fully prepared in terms of presenting our viewpoint before the Honorable Supreme Court.
Okay, thank you, sir. Very all the best for subsequent quarters, and we expect the profits to continue the same in the coming quarters. As you know, like 63 lakh investors are waiting to turn around story, and we want to do festival in our homes as well. Thank you, sir. Keep this in mind, and hope we will continue our journey with you and your team members. Thank you.
Thank you very much.
Thank you. We have no further questions, ladies and gentlemen. I would now like to hand the conference over to Mr. Prashant Kumar for closing comments. Over to you, sir.
Again, I would like to thank all of you for continuing to support the bank, engaging with our franchise. We wish all of you with your family members a very happy New Year of 2025 and best wishes for our Republic. Thank you so much.
Thank you. This brings the conference call to an end. On behalf of Yes Bank, we thank you all for joining us. You may now disconnect your lines.